Hello, my name is Mike Sinibaldi and welcome to this week's video edition of Heard on the Street. Last week I posted this chart of the gold-oil ratio. In this edition, we're going to continue our discussion about the gold-oil ratio and how it provides the basis for macro views and the context for confirming wave counts in gold, oil, the US dollar, commodities, and the S&P markets. As in any objective evaluation of the markets, the rationale, assumptions, and the thesis behind the analysis should clearly be stated. As such, the following assumptions have been made. Oil and gold have a high degree of correlation dating back to 1972. The average monthly ratio is 15.4. Prolonged declines in the ratio are recessionary in nature. During economic expansion, demand for metals and energy increases, causing gold and oil to rise. Thus, the gold-oil ratio will advance. Anticipating mean reversion rebounds can be predicted by using the wave principle. When a substantial advance in oil is due to certain risk factors, such as politics, war, OPEC policy, and inventory supply, oil prices increase on a percentage basis greater to that of gold and cause the ratio to decline. Such a development is inflationary and affects other asset classes by placing seller pressure on the US dollar while spurring higher commodity prices and lower equity prices. Should a recovery in the ratio be due to falling oil prices against moderate rises in gold, then the US dollar and equities would rally while commodities would retreat. We can use the gold-oil ratio to verify some of our assumptions and use it to see if gold or crude is overpriced or underpriced, and use the wave count to determine the direction that we expect each to follow. For today's discussion, my thesis is that the gold-oil ratio will continue to fall with the expectation that selling pressure will continue in the US dollar. Commodities will rise and equities will fall. There are several possible outcomes. 1. A mean reversion would bring the ratio back to its monthly mean of 15.4. Under this scenario, gold soars while oil modestly advances, or gold modestly advances while oil falls. 2. The ratio will continue to fall, whereas oil soars while gold modestly advances, or oil modestly advances while gold falls. Each of these outcomes would mean very different investments. That's why the gold-oil ratio is a tool, a barometer of sorts, not an exact science. That being said, does the wave principle help us determine the possible outcomes and support the thesis? To answer this question, we need to determine the projected targets of gold and oil to determine a final gold-oil ratio. Gold completed wave 4 of wave 5 blue at 1307.6 and has advanced 9% or $4,252 per contract. Friday's advance to new highs meets the minimal requirements to call the advance from 1040.70 a completed 5-wave advance. However, the wave count of the advance doesn't count complete, and therefore I remain bullish, looking higher to where wave 5 equals wave 1 at 1530. Much like gold, oil completed wave 4 at 83.875 and has exploded to the upside in an impulsive manner, logging an impressive 25% gain, a whopping $10,637 per contract. As in gold, I'm looking higher, whereas wave 5 equals waves 1 through 3 at 109.275. Now that we've obtained the price targets for gold and oil, if you are comparing your wave count to mine, here's my count of the gold-oil ratio. Given that the percentage gains in oil were greater than that of gold, the gold-oil ratio fell. Using my upside targets for each commodity, 1530 in gold and 109.275 in oil, the result would be a ratio of 14. Since the current ratio is 13.7, odds are that the decline in the gold-oil ratio is mature. If wave Y is a flat, typical termination points are the 1.272 and 1.382 reverse Fibonacci of wave B. That's 13.3 and 13.6 respectively. The maximum termination point is where wave C of wave Y equals 1.618 of wave A at 12.5. Any decline below 12.5 would mean that the count is incorrect. As I mentioned earlier, using the gold-oil ratio isn't an exact science. It's a forecasting tool and includes using what-if logic. At the weekly chart level of oil, wave C equals wave A at 120.175. It's also near the 0.786 retracement of the decline from July of 2008. Implying such a move would mean that the daily wave count of oil would continue to subdivide to a point where I would be forced to revisit the wave structures and labeling. It wouldn't be the first nor the last time, but interestingly, this level produces a gold-oil ratio of 12.73. Right in line with my projections, so keep this information handy should oil blast above my target of 109.275. Since our data supports a further decline in the gold-oil ratio, we can now turn our attention to the individual markets to gain further evidence supporting our thesis. With the gold-oil ratio declining, commodities should continue their advance. At the weekly chart level, that's what the wave count suggests, another up, down, and up sequence to complete the grand supercycle wave 3 top. The US dollar continues to weaken consistent with this thesis, yet I can provide little clarity to the wave count other than to state that the structure appears to be corrective and I expect further weakness. Even the possibility of a triangle wave pattern would be negated with a break below 75.23. Soon, the dollar will show its hand by breaking critical support or resistance and bring clarity to the wave count in the market direction. The final market that I'm going to speak about is the S&P. At the daily chart level, a top may have been struck. So far, the lower channel line has been tested on 3 occasions and is held. For Monday, the channel line crosses 1312.25. A break below this key area would bolster the bearish case. At the intraday chart level, the price action looks suspicious, meaning that if a long-term top is in place, the personality of the wave under consideration should be that of the beginning of a third wave. It is possible that a series of 1-2s formed, so that's in line with the personality of the beginning of a large third wave pattern. If so, prices need to fall hard Monday. If they don't, then odds are that this alternative count would become my operative count, where a large fourth wave triangle is building that will resolve to the upside. In conclusion, the macro view of the markets call for the following: a further advance in both gold and oil, with oil outpacing gold from a percentage standpoint, causing the gold-oil ratio to fall. Commodities will continue advance. The US dollar will remain under selling pressure, and equities should fall. I hope you found this video helpful, and best of trading.